Hello and welcome back to StockMaven, your daily source of cryptocurrency and finance news. In today's video, we're going to talk about advisory shares. Advisory shares are a type of equity that companies use to compensate advisors who provide guidance and support to the business. Unlike common or preferred shares, advisory shares are typically non-voting and do not represent ownership in the company. In addition to compensating advisors, advisory shares can also be used as a way to build relationships and network with industry experts. By bringing on advisors with a track record of success and expertise in their field, companies can tap into their knowledge and potentially open doors to new opportunities and partnerships. However, it's important to note that advisory shares can come with risks and downsides. One major concern is dilution, as issuing additional shares can dilute the ownership stake of existing shareholders. This is especially true if the company issues a large number of advisory shares or if the shares have a low valuation. To mitigate these risks, companies should carefully consider the terms and conditions of advisory share agreements. This can include setting limits on the number of shares that can be issued and the timing of their vesting, as well as establishing clear guidelines for the role and responsibilities of advisors. However, they come with risks and downsides that should be carefully considered and mitigated through well-designed agreements. Advisory shares are a type of stock that companies issue to investors or employees who provide advice or consulting services to the company. Unlike regular shares, which give investors voting rights and ownership in the company, advisory shares are typically non-voting and have limited ownership rights. The primary purpose of advisory shares is to incentivize investors or employees to provide valuable advice or expertise to the company. These individuals may have specialized knowledge or experience in a particular industry or area of business, and their insights can be invaluable to the company's growth and success. For example, a startup may offer advisory shares to investors who provide guidance on product development, marketing strategies, or fundraising efforts. A larger company may offer advisory shares to employees who provide leadership or management expertise in a particular department or function. One benefit of advisory shares is that they can be a cost-effective way for companies to obtain valuable advice or consulting services. Rather than hiring a full-time employee or consultant, a company can offer advisory shares to individuals who have the expertise they need. This can be especially beneficial for startups or smaller companies that may not have the resources to hire top talent. Another advantage of advisory shares is that they can align the interests of investors or employees with those of the company. Because advisory shares typically have vesting schedules or performance-based criteria, the individuals who receive them have a strong incentive to help the company succeed. This can help foster a culture of collaboration and teamwork, which can be beneficial for the company's overall success. However, there are also some potential drawbacks to advisory shares. For example, because these shares are typically non-voting, investors or employees may not have much influence over the company's decisions or direction. Additionally, the value of advisory shares may be difficult to determine, since they do not have the same ownership rights as regular shares. In summary, advisory shares can be a useful tool for companies looking to obtain specialized expertise or advice from investors or employees. While there are some potential drawbacks to consider, these shares can be an effective way to incentivize individuals to contribute to the company's success. In some cases, advisory shares can be a form of compensation for individuals who provide consulting or advisory services to a company. In this scenario, the individual would receive shares in the company as payment for their services, rather than cash or other forms of compensation. These shares may also come with certain restrictions, such as a lock-up period where the shares cannot be sold or transferred for a specified amount of time. Advisory shares can also be used as a way to incentivize key employees or advisors to help grow the company. By offering equity in the company, individuals have a vested interest in the success of the business and are motivated to work hard to achieve company goals. In this sense, advisory shares can be seen as a way to align the interests of the company and its stakeholders. Another use for advisory shares is in mergers and acquisitions, M&A. When one company acquires another, they may offer advisory shares to key employees or advisors of the acquired company as a way to retain their expertise and knowledge. By offering equity in the new company, individuals are incentivized to stay on board and help ensure a smooth transition. It's important to note that advisory shares come with their own set of risks and considerations. As with any investment, there is no guarantee of a return on investment, and the value of the shares can fluctuate based on a variety of factors, such as the performance of the company and the overall market conditions. Additionally, individuals who hold advisory shares may have limited or no control over the decisions made by the company, and may not have the same rights and protections as other shareholders. Overall, advisory shares can be a valuable tool for companies looking to compensate key employees or advisors, align interests, and incentivize individuals to work towards the success of the business. However, it's important for both the company and the individual to carefully consider the risks and potential benefits before entering into an advisory share agreement. That's it for today's video. If you found this information helpful, please hit the like button and subscribe to our channel for more updates on the latest trends in finance and cryptocurrency. Thanks for watching, and we'll see you in the next video.